Hello, this is Jaime Cortez with Marsh McLennan Agency in Yakima, Washington. And so this is the analysis on the PRF program, the Pasture, Rangeland Forage program for Sparta Ranch in Sparta, Tennessee. And I wanted to start off with just taking a couple of screenshots and showing you kind of how this has performed and played out in the last 5 years, 10 years, 15, 20 years, and then just a snapshot of 75 years worth of data. Again, just to look at how it's performed in that area. And then I've got some weather data to show as well. So after looking at the location of Sparta Ranch, it is located in two counties, Putnam County and White County. And so it does not cross any other grid lines. So there's only one grid, and that's grid 19379. And here's a closer look, kind of where Sparta Ranch is. And so you can see here's the county line, Putnam and White counties there. So we're just going to be looking at one grid for Sparta Ranch on the analysis here. So what we like to do is start off with either an even distribution or an odd distribution, just to kind of see how it's performed. And this here is an even distribution. What that means is you evenly distribute your coverage levels between 6 intervals. And those intervals are January, February, March, April, May, June, July, August, September, October, and November, December. So anywhere we see yellow or shades of kind of pink, purple, those are the areas that we want to pay attention to. So the yellow up top here, those are the intervals that we select. And then over on the right, loss ratios, wherever you see yellow, those are the years that would have paid out, where you would have received an indemnity. That means that the historical rainfall dropped below the 90% historic average. So that's where we want to pay attention to. And so looking at this even distribution, I see it for the last 5 years, including this year. It doesn't look so well, right? And so then we start with and I wanted to show you as well, this Putnam County, and then here's White County, just to see if the values change, because sometimes they do, depending on RMA and how they receive their data. Just wanted to compare those, and it's the same. So you're going to see two screenshots on each of these slides here for the first few slides, just to compare Putnam and White, but it's the exact same data. So 6,400 acres, even distribution. Again, same data, it's performed the same, right? So it's paid out 2 years out of the last 5, and technically this year's not done yet. So we don't know what the even May, June interval looks like, because we're still in June, July, August, September, October, November, December. So it could potentially pay out this year with this even distribution. And then we want to go and do an odd distribution. Okay, so that means you distribute your risk, your coverages between 5 intervals. And those are February, March, April, May, June, July, August, September, October, November. And same thing, it's paid out 2 of the last 5 years. This year, we're not sure yet, because we're still in the June, July interval. Still have August, September, and October, November to see how that's performed. But 2 of the last 5 years, again, not that great. White County, same thing. It's all the same data, right? Again, I just wanted you to take a look at that. And going to the next one. So then I'm going to show you here shortly what my recommendation is. But then I started playing with just some numbers here. And again, another snapshot. So taking 2024 out and just looking at the last 5 years, 2023 down to 2019. And here's the years here. it looks like, so for the last 4 out of 5 years, it paid out using a 2 interval distribution, and that was September, October, and November, December, going 45% of your coverage in September, October, and then 55% in November, December. And the reason for that, just looking at loss ratios, years paid, September, October had a 2% out of these 5 years, 2% loss ratio, which is really good. That's really great, actually. And then November, December, 300% loss ratio. So for every dollar you put in, with a 200% loss ratio, you get $2 back. 300% loss ratio, you put $1 in, you get $3 back. Right, that's how the loss ratios work. And down here, we're looking at even 2023. So last year they had a 784% loss ratio. So you put $1 in, you get $7.84 back per acre there. So really, really good loss ratios. Had we done this plan, this program, this strategy on Sparta Ranch on the 6,400 acres, I know there's a little bit more than that, but I just selected 6,400 acres just to start off with. Had we done this since 2019, your running total will be $197,000 approximately. And so that's pretty good math there. So it is a net return. That's net. That's taking out your premium, and that's just total net for the last 5 years. So then this was a quick 5-year snapshot using a 45% and a 55% distribution there. Then what I want to do is take 10 years, so from 2014 to 2023, using that same distribution, 45%, 55%, again, just to gauge kind of how it's doing, how it's performing. And running total is 144,000 approximately from 2014 to 2023. And so again, looking at the loss ratios, the last 4 years has done well. 3 previous years from 2017 to 2019 didn't perform with this strategy, and then performed in 2016, 2014, 2015 did not perform either. So again, just to get an idea, this is 2014 to 2023. So going down, then a little further back, from 2010 to 2023, so using a different strategy, because weather patterns, weather trends, they change, they vary. And so we wouldn't want to stick to the same strategy for 20 years or 15 years. I mean, you're gonna change it up every year. You want to monitor the data, look at weather patterns, look at different models and trends, and try to come up with your strategy for that, for those models and trends and whatnot. So but I just wanted to show you kind of how it's performed again. So this is a different strategy, right? Just taking the loss ratios, this row here, look at the loss ratios, just playing with it. And from 2010 to 2023, 152,000 running total, and you can see any yellow, right? Any yellow row there, that is where it's paid out. And this is using a 45% coverage in March, April, 25% September, October, and then 30% November, December. And then going down, and then just another quick snapshot. This is from 2000 to 2023, using kind of those same intervals, but different percentages there, different coverages there. And so from 2000 to 2023, you look at $377,364 there, roughly running total. And then again, just paying attention to kind of where the gaps are, meaning what years did not pay out with this strategy. And so you can see that, you know, a 3-year run where it didn't pay out, then it paid out 4, you know. So again, just looking at those things to help us decide on, you know, what strategies are best and whatnot. And going down, and this is just for your reference, just to kind of look at it, because the data goes back to 1951. And so NOAA, National Oceanic and Atmospheric Administration, they're the ones who are the third party company that we get the data from. The RMA gets the data from, and then they distribute to the different AIPs to put into their systems, right? And so we can look back, you know, 75 years now to look at the data. And here's I just wanted to play with it just to see, you know, what that looks like. So from 1951 here to 2023, just looking at maximizing what that would look like had we had this plan program. Of course, values change. You know, this isn't, you wouldn't have paid 25,000 per year, but just looking at the loss ratios, I just wanted to see how that performed. And so, and to show you, you know, what the data looks like. And we can see what I call those gaps, right, where it didn't perform. And so you can look at the data and say, long-term strategy, this is going to work, right? PRF has been working for ranchers. That is why many ranchers are doing it. It's just part of their budget. It's part of their strategy. They know some years it's going to pay out. They know some years it won't. And some years they're going to pay a portion of their premium, right? They may not have to pay their full premium, but they'll have to pay a portion of their premium. And they're okay with that because they know that they depend on rain. They depend on rain to produce forage so that their cattle can feed. And when it rains, you know, they're able to feed their cattle, and they don't have to bring in extra hay. They don't have to ship or move their cattle around, right, because of drought and things like that. So this is a great program, and it's a great strategy for ranchers. And so after looking at all that data, now I'm going to go back, and this is what my recommended strategy for 2025 crop year would be for Sparta Ranch, is that, you know, on 6,400 acres in grid 19379, that you would do a 40% of your acres in September, October, and then 60% in November, December. In Tennessee, the maximum amount of coverage that you can put into one interval is 60%. In other states, other areas, the maximum can go up to 70%. The minimum that you can put into one interval is 10%. But just to maximize what the ranch has to offer, that area, that grid, I would suggest that we would do 60% of our coverage or our acres in November, December, and then 40% in September, October. And the reason for that being, and I said this earlier, is that, you know, for the last 5 years, from 2019 to 2023, that the loss ratio in September, October is 200%. And then the loss ratio in November, December is 300%. Looking at the other intervals, you can see that the loss ratios are below 100%, right? So we want the loss ratios to be more than 100%. And once they get up to that 200, 300, 400, I mean, those are the ones that you want to capitalize on. And so looking at the last 5 years, that would be my recommendation, is that we maximize that and go with the September, October interval and November, December interval. And so had we done this since 2019, the running total will be $201,000 approximately. Again, last year in 2023, 787% loss ratio, which is very, very good. And that's Putnam County. And again, I just wanted to compare White County. It's the same exact information and data. So that would be my recommendation for Sparta Ranch going into the 2025 crop year. And so looking at weather data, weather models, this is in May. This was issued in May. And this is from the International Research Institute. And so they put out weather data and models. And so it's in partnership with Columbia University. So they're very well-known, well-respected, university, but also the models are very good at just kind of looking at trends and predictions. And so this is trend for this July, August, September. And I'm showing you this because weather patterns tend to repeat themselves, right? Tend to. I know that these last few years we've had some crazy weather, volatile weather, and it's very unpredictable. But we want to kind of look at those and say, okay, if this is the trend this year, is it going to happen next year? And so looking at where Tennessee is here in this area for July, August, September, it can go either way. So the yellow, the orange, the brown, right? That means that there's a high probability that it's going to be below rainfall, below average. Whenever you see green, that means it's going to be above average rainfall is what they're predicting. And so looking at a little further, August, September, October here in Tennessee, you can see a little yellow in that area. So the previous, slide is kind of either way, it's white. We're not quite sure. But then as we're looking at August, September, October, now we're starting to see a little bit yellow there. So more or more likely to not have precipitation. And then September, October, November, you can see some more yellow kind of going just along the edges on the west side of Tennessee, and then on the east and south of Tennessee there. And so pretty soon we'll be able to look at, October, November, December. And so just looking at those trends, looking at kind of how that will play out, my recommendation would be to look at that September, October interval and November, December interval, just based on the 5-year data and then based on the IRI model of probability for precipitation in that area. Now I also wanted to show this here just to show you how it's performing this year in the 2024 crop year, grid 19379. So January, February, it's already above. So the index, if it's below 0.90, that's 90%. If it's below that, that means, it's performing for you if you had that interval on your PRF plan. If it's above 1.0, or excuse me, if it's above 9.90, then it's raining more than 90%. So just looking at for this year, March, April interval, it had 89%. The index ended at 89%. And so we're not sure, again, where the rest of the year is going to go. We're currently in the June, July interval. So I just wanted to share that with you, just to show how it's performing this year so far. And, if we were going to go with the 60-40 strategy, then, that's not till September, October, November, December. And I'm thinking we're trending that way. So again, Mother Nature is undefeated. We don't know. We can't out-predict. We can't, guess. But what we're trying to do is use the data to make some informed decisions to help, mitigate any risk, to help, just strategize on how to indemnify you if there's a loss, as it relates to crops and livestock. So I wanted to show that to you. But again, I'm just going to go back to here in Putnam County. This would be my recommendation for the PRF policy for the 2025 crop year, is that it's a 40% in September, October, and then 60% November, December. The premium, and I haven't talked about this yet, the premium to Loving LLC or Sparta Ranch would be $25,981. That's what you would pay. This is a government subsidized program, so the government will pay 51% of the total premium. So the total premium would be $53,022, right? They would pay 51% of that, then Sparta Ranch would pay $25,981 if they had to, if the premium was owed. And in order to get that subsidized premium, there needs to be an AD 1026 on file through the local FSA office in Tennessee there near Sparta Ranch, the closest one there. All right. And again, that's an AD 1026. And that just means that you're not going to be farming on highly erodible lands, wetlands, etc. It's a simple form. Everybody has to do it, has to turn that in if they want that subsidy for any, and it's just a one-time deal. So for any of their crops, commodities, yeah, just you want to get that in. Unless if you don't want to do that, then you've got to pay your full premium. But everybody, turns in that AD 1026. Again, that would be your premium. To break it down a little bit further, the acre premium, if you're interested in that, it'd be $4.06 per acre in Putnam County. And so that's what the breakdown is. So 6,400 acres times that $4.06, that's what's going to get you your premium there. I hope this is helpful. I'm going to obviously put this in an email for you as well. But I just thought it would be best to kind of walk you through this so that you can refer back to it whenever you want to. And then I also included a slide on livestock risk protection, because I know we talked about that. And this is a quote from RCIS, and looking at steers weight 2, because you said that the cattle they're going to get to about 1,000 pounds, and that's about it. So 2 categories, I think: steers weight 2, heifers weight 2, and then I've got some unborn, because I think you mentioned you're going to have some pregnant cows there too. And so depending on how many pregnant cows, you can have some unborns as well, which that might be the better option for Sparta Ranch. If you feel that the steers weight 2, heifers weight 2 aren't going to, align with your goals in terms of livestock risk protection. And I apologize if this is kind of small. I can make that a little bit bigger. But you can go out, endorsement lengths, you can go all the way out to 47 weeks, right? So from 13 weeks to 47 weeks, looking at the end dates, the expected ending value, and this is coming from the CME, Chicago Mercantile Exchange. These are coming from there. You can have coverage prices, so you can almost get to 100% of the expected ending value. And then producer cost, insured value, so that's total liability there. What the total premium is, this again is subsidized by the government at this level, between the 95 and 100% coverage level. You're looking at 35% subsidy. But let's just say you wanted to lock in 100 head of steers weight 2, meaning they're going to reach a target weight of 1,000 pounds by May 7th of 2025. So that's a 47-week endorsement. And so you said, yeah, I like that. I like that expected ending value, meaning I think they're going to be lower than that, or they're going to be right around that. And so you're just protecting that price. What you're protecting is $259.77 per hundredweight. Okay. And so total premium would be $16,654, but your premium would be $10,000 $825. And then it breaks it down by cost per head for the producer as well. That's kind of how it works, right? And then, so come May 7th, the prices come out. If you fall below that, meaning if the ending value is below our coverage price of $259.77, well, then you're going to get paid, right? And I understand that your beef is going to be a lot higher value. So this is playing the market, which may not pertain to your operation, but this is how it works. What I think might be more beneficial to you would be the unborns, right? So similar, the values are a little bit higher for unborns, right? The lighter the cow, the more valuable in terms of per hundredweight. So we did the same thing. You know, you want to do 100 head of unborn steers or heifers. I mean, they categorize them in the same, right? Because we're maybe not quite sure if they're going to be female or male. But if you said I wanted to lock in 100 head, 47 weeks, the ending date is May 7th. The expected ending value is $273.62 per hundredweight. I can get a 99.68% coverage level. So that coverage price that I'm protecting is $272.76 per hundred. And then, so there's a total premium, but the producer premium would be $6,809 for you to lock in 100 head of unborn steers and heifers out until May. And so if that price, the actual ending value comes in below that, you're going to get paid. And these premiums are not paid until the end of the endorsement. So it gives you time to market your cattle, other cattle, make some money, and then, you know, pay your premium. Same thing with the PRF program. Sales closing date is December 1st, but you're not going to pay until, if you have to pay, you're not going to pay until the end of September of 2025. So hope this helps. Again, there's a lot of information here. There's so many different strategies and options. We just want to offer you with advice, offer you with some guidance, and then ultimately it's up to you to make the decisions that the best suit meet your needs and goals of the operations. So please let me know if you have any questions. Obviously we'll follow up with a phone call and you know, things like that. So hope all is well, and we'll talk to you soon. Thank you.